Hi, Aaron Vale, Managing Director at CBRE Investment Management, co-head of our indirect infrastructure group. At CBRE Investment Management on the indirect side, we build separate accounts, customized portfolios for experienced investors that want a unique experience for infrastructure investment. We combine funds, co-investments, secondaries, and direct investments to build a customized product for our investor base. We've been doing that for over a decade. Today we manage a couple dozen of separate accounts with over $5 billion of assets under management. The relationship between inflation and infrastructure businesses is multifold. On the most simple level, inflation is going to affect your operating cash flows. We see that on the revenues, on our operating expenditures, and our capital expenditures. Infrastructure businesses benefit from an inflation correlation due to a positive operating leverage, typically seen through a high EBITDA margin. So all else being equal, an increase in inflation should increase operating cash flows. But the impact to inflation on infrastructure businesses also affects projected cash flows and financing cash flows. There, the relationship's a little more nuanced. Typically, inflation and higher inflation can lead to higher interest rates, so that could lower your cash flow to investors through higher financing cash flows. It could also lead to a higher discount rate, all else being equal. So that's why I say inflation and infrastructure, typically positive, but not necessarily for all businesses. Inflation can affect your benchmark depending on which type of benchmark you're using. So let's go through the various benchmarks and see where inflation affects it. The most straightforward example is CPI plus 4%, 5%, which is a very common investor benchmark. That relationship should be pretty straightforward. What inflation results in will affect your benchmark one for one. Other common benchmarks could include a listed infrastructure index or a fixed income index, typically through real return bonds. The real return bond or the fixed income relationship with inflation is also well understood. There, you have duration impacts. You might see a pretty good correlation between changes in inflation and your fixed income index. The relationship on equity indices or equity benchmarks is less straightforward and often ties to whether we have high inflation with high growth, high inflation with low growth, and other macroeconomic factors. The one benchmark which has very little relationship to inflation is actually absolute benchmarks. Some investors will target 7% absolute, 8% absolute in infrastructure portfolios. We see that absolute benchmark most notably with fund managers. Fund managers with their carried interest models have 7%, 8% benchmarks, and those actually have no relationship to inflation. So it really depends on what your choice of benchmark is and the relationship with inflation. That's the million-dollar question. The relationship between inflation and interest rates is kind of like the tail wagging the dog. Typically, high inflation should lead to higher interest rates by central banks to temper that high inflation environment. And that is where higher interest rates have profound impacts on infrastructure cash flows through refinancing, but also through return assumptions, cost of capital assumptions, even exit assumptions. So the relationship between inflation and interest rates really depends on central banks and the prevailing economic realities that governments and kind of societies are trying to manage at the time. The devil is in the details. Hypothetically, all infrastructure sectors and strategies should benefit from inflation because of the positive operating leverage, positive margins. But let's delve into it a little more by sector basis. Certainly with renewables and digital infrastructure, there are huge tailwinds. There's huge investment needs for these sectors. And despite high inflation flowing through to higher capital costs, higher construction costs, the need for these types of investments trumps all. And those investments are largely able to pass through inflation through their contracts or through a recontract. We also have regulated utilities. Regulated utilities have an explicit inflation protection through their regulated review. So any changes in inflation can flow through directly to your regulated rate of return. GDP correlated businesses, airports, toll roads, ports, are able to pass through inflation to their end customers based on supply-demand dynamics. The more essential one of these GDP transport businesses, the higher barriers to entry it enjoys, the more it is able to pass through inflation to its customers. CBRE Investment Management has a full-fledged macroeconomic research team who delves into all these pertinent questions around inflation, interest rates, and the impact on real assets, including infrastructure. Please refer to our websites or reach out to any of our CBRE investment management professionals if you'd like to learn more about how our macroeconomic research flows into our investment making decisions.